The 2017 tax legislation has significant implications for all businesses. That's why KPMG has created this video series, Tax Reform, Big Changes, Important Questions, to help you prepare. Today's question is, given the changes made by the 2017 law, does it make more sense for your business to be a C corporation rather than a pass-through or sole proprietorship for federal tax purposes? This is a critical question, and the answer is complicated. And even if you've done the analysis before, you might want to think some more in light of the final regulations on the new deduction that were just issued on January 18th of this year. For 2018 returns, taxpayers can rely on either these regulations or the proposed regulations that were issued in August of 2018. But after 2018, the final regulations govern. Some owners of pass-throughs may benefit a lot from the new deduction for qualified business income, while others may benefit a little or not at all, depending on their particular facts. Under current law, any benefit is only available through 2025. Legislation would need to be enacted to extend the deduction beyond its scheduled expiration. The 2017 law made permanent a reduction in the general corporate rate, the so-called C corporation rate, to 21%. This benefit is not scheduled to expire, but there is still a double layer of tax on C corporation earnings. With this in mind, how do you decide how to proceed? The answer is very fact-specific and requires an understanding of both present and expected future business activity. It also may require thinking about how stable you think the current tax provisions might be. Keep in mind that future legislation could be enacted, changing the relevant tax rules. But as a starting point, here are some key questions that may influence the conclusion. Is any of your trade or business able to benefit from the 20% deduction? Is there a cost of getting into a C corporation? What is the anticipated exit strategy for the business? Will cash be retained or distributed by the business? Is there a state tax deduction that would be available for a C corporation but not for an individual? Is there a state tax difference between being classified as a pass-through and a C corporation? Are there any non-tax drivers to the decision, such as complexity of reporting or investor attractiveness or other drivers? Are there any international considerations? The decision must be made carefully. C corporations can be a roach motel. Once you get in, you may never get out, at least not without paying a significant toll charge. Want to know more? Watch one of our other videos on 199A for more information, or visit KPMG's tax reform webpage, read.kpmg.us/tax-reform.